The market may be closer to a major 2026 breakdown than most people realize. Google's AI-driven macro analysis systems, the same algorithmic frameworks that process billions of data points across global markets, are flagging warning signals that mainstream financial media either does not understand or deliberately ignores. This isn't about speculative headlines. This is about pattern recognition at a scale human analysts cannot match, identifying clustering of peak signals across asset classes that historically precede systemic unraveling. Here's the paradox. Markets appear stable on the surface. Volatility is contained. Equity indices remain near all-time highs. Yet, simultaneously, Google's macro models are detecting peak clustering, a phenomenon where multiple disconnected asset classes reach extremes simultaneously. Mega-cap tech stocks, cryptocurrency markets, bonds, and real estate are showing late-cycle characteristics in synchronization. When AI systems trained on a century of market data flag this pattern, and when funding stress metrics begin deteriorating while yield curves signal stress, you're not looking at random noise. You're looking at preconditions for systemic breakdown. I'm going to show you a pattern so reliable, so mathematically precise, that once you understand it, Google's 2026 crash prediction transforms from fear-mongering into recognition of a cycle that has repeated with devastating consistency. It's called the three-stage market peak clustering cycle. We're watching stage 3 execute right now: synchronized peak formation and funding stress acceleration. The phase where all major asset classes have reached valuations requiring perfect conditions to sustain, while the funding mechanisms supporting those valuations are quietly deteriorating. Let me define the mechanism. Stage 1 is monetary expansion and asset inflation dispersion. The cycle begins when central banks inject massive liquidity after a crisis. Initially, this inflates specific asset classes, typically equities. Other markets may lag. The peaks are asynchronous. Stocks might surge while bonds remain depressed. Critically, funding markets remain healthy. Credit spreads are tight and liquidity is abundant. And this stage can last years as liquidity works through the system. Stage 2 is peak convergence and volatility suppression. As monetary expansion continues, liquidity eventually inflates all major asset classes simultaneously. Stocks, bonds, real estate, cryptocurrencies all reach extremes. This convergence reveals excessive liquidity has saturated the entire system. Simultaneously, volatility becomes suppressed. The VIX trades at historic lows, credit spreads compress. The surface appearance is stability, but the underlying condition is fragility. All assets priced for perfection with no room for error. Stage 3 is funding stress, emergence, and synchronized breakdown. While asset prices remain elevated, funding markets begin showing stress. Repo rates spike unexpectedly. Credit availability tightens. Yield curves that were inverted begin steepening not because growth is returning, but because long-term rates spike due to funding stress. These funding indicators matter far more than stock charts, because they reveal the liquidity supporting elevated valuations is becoming scarce. When funding stress reaches critical levels, the breakdown occurs simultaneously across all asset classes, because they're all dependent on the same liquidity infrastructure. Now let me prove this pattern with two historical cases. The first is the 1929 crash. Stage 1 was 1924, 1927, when Federal Reserve easing flowed primarily into equities. Stage 2 was 1928 to 1929, when all asset classes peaked together. Stocks surged 300%, real estate peaked, bonds bid to rich valuations, volatility suppressed, margin debt exploded. Stage 3 was the funding stress in summer 1929. Call money rates, the cost of margin lending, spiked. Credit tightened. In October 1929, the breakdown was synchronized. Stocks crashed 25% in days, but bonds collapsed as defaults surged, real estate plummeted, and currencies faced stress. The crash was systemic because all assets depended on the same credit expansion. The Dow ultimately lost 89%. The second case is 2007-2008. Stage 1 was 2002-2005, when Fed liquidity flowed primarily into real estate. Stage 2 was 2006-2007, when all assets peaked together: housing, stocks, emerging markets, commodities. Oil hit $147, credit spreads at historic lows, VIX below 10. Stage 3 was funding stress in 2007. Asset-backed commercial paper markets froze in August 2007. Repo markets experienced stress. LIBOR OIS spreads widened. When Bear Stearns and Lehman collapsed, the breakdown was synchronized. Stocks crashed 50%. Real estate collapsed. Corporate bonds defaulted. Even money market funds broke the buck. Oil crashed from $147 to $30s. Both cases show identical mechanics. Monetary expansion inflates assets asynchronously, then all assets peak together, signaling liquidity saturation, and finally funding stress triggers synchronized breakdown. Now here's why Google's AI models are predicting a major 2026 crash. Stage 1 was the 2020-2021 COVID monetary expansion. Central banks injected over $10 trillion globally. Initially, this inflated tech stocks and growth equities, while other assets showed mixed performance. Stage 2 is the 2022-2024 peak convergence we're witnessing. Now, virtually every major asset class has reached extremes. Mega-cap tech stocks trade at valuations requiring perpetual growth. Crypto, despite multiple collapses, has surged back near all-time highs. Treasury bills and money market funds hold record assets. Real estate hasn't meaningfully corrected. Gold trades at records. This convergence reveals liquidity saturation. Volatility suppression is extreme. VIX remains stubbornly low despite uncertainty. Stage 3 is the funding stress Google's models are detecting. While asset prices remain elevated, funding indicators are deteriorating. Reverse repo facility usage swings wildly, indicating liquidity distribution problems. Bank lending standards have tightened significantly. Commercial real estate faces a $1.5 trillion refinancing wall. Corporate debt markets show increasing stress. The yield curve is steepening not from growth, but from term premium concerns and funding stress. Google's AI models, trained on decades of data, recognize this pattern. They're detecting what human analysts miss. Funding stress matters far more than current stock levels. Markets can remain elevated as funding deteriorates, but when stress reaches critical thresholds, breakdown occurs, suddenly affecting all assets simultaneously. Let me check the boxes. Are multiple asset classes at simultaneous peaks? Yes. Mega cap stocks, crypto, bonds, real estate all showing late cycle valuations. Is volatility suppressed? Yes. VIX remaining low despite fragility. Are funding stress indicators deteriorating? Yes. Reverse repo volatility, lending standards tightening, commercial real estate crisis, yield curve dynamics signaling stress. Stage 3 is executing. Here's what mainstream analysis misses. They focus on stock charts and earnings reports. That's backward looking. Google's AI models and sophisticated risk frameworks focus on funding markets, repo rates, credit availability, liquidity distribution, yield curve dynamics. These funding indicators lead price action because they reveal whether liquidity supporting elevated valuations is reliable or fragile. The 2026 timeframe isn't arbitrary. Funding stress indicators suggest 12-18 months before critical thresholds are breached. Commercial real estate refinancing peaks in late 2025 into 2026. Corporate debt maturity walls hit hardest in 2026. The lag between funding stress emergence and market breakdown has historically been 6 to 18 months. Here's what this means for investors. If you're positioned based on stock charts and recent performance, you're using the wrong framework. The market can look fine on the surface while being fragile underneath when funding stress is building. The smartest risk frameworks focus on liquidity indicators and funding market health because these determine whether elevated valuations are sustainable or about to reprice violently. When stage 3 breakdowns occur, they're synchronized and brutal. You cannot diversify away because all assets reprice together. The only positioning that survives is reducing leverage, increasing liquidity buffers, and holding genuine safe assets, not assets bid up by the same liquidity that inflated everything else. Pattern recognition beats prediction. And the pattern Google's AI models are detecting is screaming that we are in stage 3 of a market peak clustering cycle where all major assets have reached extremes simultaneously. Volatility is suppressed, but funding stress is accelerating beneath the surface. This is the exact configuration that preceded 1929 and 2008. The breakdown timeline projects to 2026 based on current stress acceleration rates. Position yourself accordingly, because when funding breaks, the repricing will be synchronized, violent, and devastating to anyone positioned for continued stability based on surface-level market calm.